There's a specific point where your investment proves that your strategy is paying off. These are the tipping points, the spark that leads to an explosion of success in your investing journey. In today's Invest With Me video, we'll talk about that exact moment where your investments starts working harder than you do. If you're new here, my name is Ron and welcome to Pinoy Stock Investor. But before we start, let me know down in the comments, what is your I did it moment in your investing journey? It'll be a really great share to the community. Okay, let's start with a quick market check. All right, let's look at the Fidelity portfolio. Fidelity app. We'll start with the S&P 500. It is currently down by 0.34% or 34 basis points. Next is Dow Jones. It's currently down by 0.76%. Next is the QQQ or NASDAQ. It's currently down by 0.24%. A lot of red days today. Okay, now the full portfolio is currently down by 0.34%, which is $631. Okay, looking at our taxable portfolio, it is currently down by 0.34% or $420. All right, today we're going to invest $100. Okay, let's go plug it into our Google Sheet. So $100. $100. We are going to invest $100, and currently for industrials we are going to invest $10. Next is to financials. We are going to invest $10.5 per company. Next is communication services, which is we're going to invest $15 each company in there, and for technology we're going to invest $13. These amounts per company is not set. This is just a guide or how we're going to divide this $100 to each of the sectors that we have in our portfolio. Okay, let's start with Uber. Okay, starting with Uber, we are going to invest $10 to Uber. All right, so $10. Okay, $10. Okay, that is 0.135 shares of Uber. Next, we're going to invest to MasterCard. All right, MasterCard, we're going to invest also $10, and that is $10, and that is 0.019 shares of MasterCard. Next is Meta. We are going to invest $15 in Meta. Okay, look for Meta, and right now we're going to invest $15 to Meta. $15 is 0.023 shares of Meta. Okay, let's start with our first tipping point. I call it the six-figure gravity. This is when once you reach or you hit your first $100,000, it's a simple 1% movement of the market makes a really huge swing for your portfolio. Imagine 1% of 100,000 is $1,000. So every time swing positive or negative, your portfolio is swinging $1,000 momentum. So if it swings $1,000 positive, your $100,000 is going to be $101,000. If it swings on the other end, it will be $99,000. But this sheer size of position begins to generate its own momentum. So right now, my portfolio is currently down by 0.2 34%, which is already a $631. That's a full portfolio. It's already $631 down, like what we mentioned earlier. And this $631 down is an opportunity or a momentum for me. So I could add or buy more shares of the companies that are down, or my buy portfolio, like what I'm doing right now. I'm going to be able to buy these companies at most a little 0.34% discount compared to the previous price yesterday. It might not be as cheap as when it's really down or the market is down, but it still generates momentum for my portfolio. That means if I'm currently in the green in that position, my cost basis wouldn't go up, but the amount of shares that I'm going to have is going to be increased. Granted that it's a little bit, but a swing to positive side is still a swing to positive side. A gain is still a gain. That's I know, that's what I say. And this momentum is the one that help us to push the portfolio on the positive side. Or when the portfolio moves to the positive side, it would increase the movement, or it would push that pendulum a little bit more, because we did increase the size of our shares today. So that is the six-figure gravity. Now, we're not only going to discuss the tipping point. We also have that tripping point, wherein these are the things that an investor does to limit that momentum or limit that growth. So one of these tripping point is when you allow the headlines to scare you to making any investment decisions. I call it the news cycle panic. It is when allowing a single negative headline to scare you into selling an investment that has been winning for years. So at least winning for you for years. Right now, the best example of this one is, for me, in my portfolio, is Apple. It's been winning for at least 6 years now, and they were never short of negative news. There will always be a negative news when it comes to Apple. And last year was about AI, and it still bleed through to this year, and they're still getting news, or getting that negative news about not making an AI for their devices. And I think Apple is weathering it down really well. Currently, I'm up in Apple, and definitely Apple has been a really best performing in my portfolio. And one thing for sure is that I'm not going to allow one negative news to dictate the kind of investment strategies I'm currently doing right now. And I'm not going to sell Apple just because they're not doing, or just because they're not releasing their own AI strategy. Okay, let's move on to buying more stocks. Okay, let's move on to the next communications company, which is Google. Okay, we are going to invest $5 to Google, and that is 0.016 shares of Google. Next, we are going to invest in Berkshire Hathaway. Okay. So Berkshire Hathaway, we're going to invest $10. Okay. And that $10 is 0.02 shares of Berkshire Hathaway. Okay. Now, next is Apple. Okay. Currently, we are up. The total gains in Apple is $9,100, which is 63.29%. And I love that 63.29% positive gains to Apple, from Apple. Okay. And today we're actually down by 0.30%, which is $68. And we're going to buy $10.50 of Apple. Okay, that is 0.04 shares of Apple. Okay, the next tipping point, that one of the things that I love, like I learned, is that you, when at some point you're gonna understand these businesses that you, well, the best case scenario is like when you're trying to invest in them is you're trying to learn the business. But sometimes people just buy the stock because they see that it's going up. They're, I know people that are buying the stock because it went up. They think that they're trading and everything, but they're getting FOMO, and they're trying to just buy this kind of stocks. And this tipping point is called the psychological decoupling, which is when you stop checking the price of the market daily because you realize that the underlying business is doing the work. Your transition from a trader to a business owner. So I've never really invested in a company and trade it, like buy it on a green day today and then sell it on a green day tomorrow, or buy it low today, because you can never really time it. And I don't understand trading. I mean, I understand the principle of it. You buy low, sell high, or you buy high and sell higher in the positive note. But yes, I've never really understand that. But what I understand is that when you own a stock for a long time, you start to understand how the business works, like how the foundation or the back end data of it. You're able to read their accounting, their cash flow statements, their earnings. You start to understand those kinds of things. And the more you understand them, the more you understand how the company makes money, and how the company becomes profitable. And that's one of the greatest thing. And that's when you understand that your investment is doing the work for you. And in the opposite side of this is the tripping point, where it's called the premature harvest, which is the selling of your winners or taking gains too early to lock in those small gains, which prevents the stock to ever becoming a 10x or a 100x growers that creates a real wealth. I know beginner investors they were already taking gains, even though if their gains is just about 0.01% or $20 gain, a $30 gain, a $100 gain, they already cut, or they already sell those positions to take that small gains, not knowing that if you just hold on to the company, it will, and understand the company. Okay, of course, you need to see, or you need to understand the company is not overvalued. If you just hold on to the company and it performs and it just beat all the expectations or the negative expectations against the stock or against the company, it will reward you just by holding it. The best example of this is, for me, is Google. Back when they still have their court cases about being a monopoly, the stock valuation is at the low end. I was able to buy a sub 200 value of stocks of Google. Now, after they closed this lawsuits, and after they closed all these issues, and they were able to release all their AIs and everything last year, their stock definitely run up, and it did double my investment. It reached at least 90% gain on my investment. So it's quite there to the 2x level. It's not in the 10x level, but it's in the 2x level. And I'm very happy that I did not sell, or I did not take any gains that I had. Okay, that's one of the best example for me. For you don't really need to sell to take the small gains. And do not do that, because you're definitely going to stop the momentum, the growth that the stock is experiencing on your portfolio if you take those small gains. Okay, next, let's move on to investments. We are going to invest in Microsoft. Okay. So we are currently up in Microsoft. We are up by 22.82%. That is $3,800. And for today, we are currently down by 0.53%. All right. We are going to invest $20.27. Yeah, that's just random. $20.27. And that is about 0.05 shares of Microsoft. Okay, next, we are going to invest in Amazon. Okay, so right now, all that's left to available cash that we have on our account is $20.33. So we're going to put $20.33 to Amazon. And that is 0.095 shares of Amazon. Okay. Now, the last point on our topic for today is the contribution crossover. For me, this is one of the best thing that shows that what I'm currently doing is working. So the contribution crossover is when your annual market gains exceed the total annual deposit that you are currently adding to your portfolio. So background, for the last 3 years, I've been consistently adding to my portfolio. So back in 2023, I added $9,000. And back in 2023, my portfolio return was $8,000 or 16%, which is almost doubling the deposit that I did to the portfolio. Next is 2024. I deposited $18,000 and the return that I got is $15,000, which is 20% gain that year. So it's another close to doubling my deposit. And last year, 2025, I deposited $13,000. And for the first time, the return is more than the amount that I deposited. 2025, the portfolio return is $16,000, which is one of the signs that whatever I'm doing definitely is working for me. And on the other side, this tripping point is one of the things that really cuts everything. It is when you subsidize your lifestyle using your portfolio. It is when you withdraw your growth to buy things that doesn't retain their value or doesn't produce any value. It can be luxuries, it can be necessities, it can be things that you need or things that you want. But whatever it is, once you withdraw the growth from your portfolio, it would definitely affect your growth negatively. Your compounding will be stopped at that point. So do it at your best that you don't withdraw anything or don't stop the compounding of your portfolio. At some point, your consistency will always be rewarded. Every brick that you stack up will make your investments grow stronger and more stable. Once you reach that level where a market dip feels like a bump in the road instead of a crisis, that is the ultimate sign that your strategy is working. So keep it up, keep stacking those wins, and when you hit that tipping point that we're talking about today, or any tipping point that you notice, come back in this video and let me know down in the comments, or you can always put "I did it" down below, and I'll make sure to congratulate you. If you get value in this video, don't forget to subscribe and like this video. It's free and it will definitely help my channel. I hope you guys like this video. Have a great day and peace.